Good morning, everyone. Well, Friday's U.S. employment data was much better than expected, with the growth in non-farm payrolls exceeding expectations, previous months revised up, and average earnings rising. Nonetheless, the surprisingly good data did really very little to help the dollar. This morning, the dollar is substantially higher against only the Canadian dollar, the Australian dollar, and the New Zealand dollar. And these were currencies that really had their own reasons to weaken. The U.S. currency is lower against the Swedish krona, the Swiss franc, and the euro. The dollar did gain against most emerging market currencies, though, but whether that was due to the U.S. data or to renewed tensions in Ukraine is hard to tell. In fact, the muted reaction to the non-farm payrolls really isn't that surprising. Looking at the last 6 times the non-farm payrolls have beaten estimates, the dollar was on average lower against the euro, sterling, and yen a week later than it was the day before the figure came out. In any event, it seems that it will take more than just one better than expected figure for the market to change its view on the dollar, particularly in the light of weaker data from China. Copper hit a new low for 2014 on Friday after the default of Shanghai Chaori Solar Energy Science and Technology Company. This is the first default in China's onshore bond market. That may signal a change in stance by the authorities. It means troubled companies won't be bailed out in the future. Copper continued falling in Asian trading this morning as disappointing Chinese trade figures for February released over the weekend added to the gloom. Since a lot of Chinese companies have pledged metals as collateral for loans, it's likely that a credit crunch there and further defaults will cause more distressed sales of metals and commodities, putting downward pressure on the entire asset class, not to mention the Australian dollar. However, the Canadian dollar was the biggest loser among the G10 currencies, as the market ignored the much better than expected trade data for January and focused on the continued weakness in employment in Friday's figures. Dollar-yen was relatively unchanged despite a weaker than expected revision to Q4 GDP and a slightly wider trade deficit than expected in January. This is worth noting because risk aversion has in the past trumped negative news on the domestic economy to push the yen higher, especially with the stock market down. So we could be at the start of a renewed bout of yen weakness. That would suggest buying that the Swiss franc is likely to gain on the yen during any bouts of risk aversion. I still believe the weakening trend in the Australian dollar and Canadian dollar are the most likely plays in the market. The failure of sterling to make a new high for the year against the dollar is worrisome, although I'm not yet changing my view on the currency. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.